Hello, my name is Mark Juane. I'm the Director for Business Development and Training at Archeo Financial Services. Thank you so much for taking a few minutes to watch this presentation. I'd like to begin with asking you an important question. Is there ever a time or a situation where it's okay for you to lose money? Now, I think that's a no-brainer. I think you would agree with me that that's a no-brainer. Nobody wants to lose money. Nobody would want to lose $100 or $500, let alone $10. But imagine if you were losing $10 on a regular basis, $20 on a regular basis every month. That's not a good thing. Well, the reality is that we're all losing money. Right now, you and I are probably losing money. How do we do that? Well, through inflation. We lose money through inflation because inflation affects the value of our money, even if it's just sitting in our bank account. It also negatively affects the value of our investments, even when they're making money. Inflation digs away at the value and the purchasing power of our dollar. A second way that we lose money is through taxation. Taxation negatively affects both our income and our investment, right? Because of taxation, we have to pay that. Some people don't realize that when you put money in the bank and you're just saving it there, at the end of the year, let's say you put it into a high interest savings account and you're getting 3%. That 3% that you make at the end of the year, throughout the year, and it accumulates at the end, the bank has to report that, and you will be paying taxes on that interest that you earned from your bank. So rather than actually making 3.25%, you're making 3.25% less whatever the percentage, maybe it's at 40% uh, of your taxable rate. Another way that we lose money is through finance fees. And this is the money that we end up giving to our bank every month. If we have banking fees, that's that $10 every month, or that we're charged by the lender when you got your mortgage or when you got a loan for your car. We pay extra for that. We pay extra to borrow money. Now, these money killers are out of our control as long as we play the same game as everyone else. So tonight, at this moment, I want to show you what arguably is the best saving strategy you'll ever find using life insurance. Now, before you immediately write me off because I mentioned the words life insurance, I want you to consider this thought. Don't reject something for what it is until you understand what it does. See, quite a number of people, the moment they hear those two words, life insurance, immediately shut down. It triggers them to put up their shields, to stop listening, and to walk away. Tonight, I'm going to ask you to suspend your skepticism for a few minutes. And if what I share with you doesn't make sense, go ahead and continue to be skeptical about life insurance, and I won't bother you again. Fair enough? Now, there are two things every responsible adult must have. They must have a savings account or checking account and a savings strategy. Your savings account is what you need for your immediate financial needs, and a savings strategy is what you need for your long-term financial needs. So let's break it down a little bit. What do you use your savings or checking account for? Well, a lot of people commonly use it for this. Your checking account is used, you access your checking account, by the way, or your savings account through your debit card when you buy groceries, when you put fuel, pay for gas in the car. If you don't have a car, you're going to use your savings account or your checking account to pay for your bus tickets or your card that you use to get on and off transit. And of course, you got to eat, so you're gonna get it from there. That's where you're going to get your money from, right? Now, what about a savings strategy? What would be the difference? For a savings strategy, like we said, this is for your long-term serious financial needs, right? Things like buying a house, putting a down payment on a house, furnishing that home, or if you already own a home, doing some renovations, right? It's expensive to do those renovations, expensive to get a roof done again, it's expensive to do plumbing or to remodel a kitchen. If you want to fund your retirement, you're going to need a savings strategy, a way to to save money to be able to have it at the end of your life. A new car. If you plan to buy a new car, you're going to need a savings strategy to make up for that. And if you already have a car, you're going to have to maintain it and you're going to have to repair it along the way. You're going to need money for that. You don't want to be surprised, right? With big expenses like that. If you plan to take vacations from time to time, you're going to need a way to save money, right? If you want to start a business, you're going to need capital to start a business. How do you get that capital? Well, a lot of people self-finance in the beginning, at least, before they approach a bank for a loan. If you love investing and if you want to make money investing, which is great, but you need capital to invest. Where are you going to keep your capital? We're going to store your capital before you find that investment that you want to invest in. Or if you want to continue your education, you need a savings strategy so that you'd be able to pay for your tuition and other expenses related to your continuing education. And of course, most people have credit cards, and if you're going to manage your credit card debt, you need to have a plan. You need to have a savings strategy to be able to pay off credit card debt. Now, what do most of us have? Most of us have a savings account or a checking account that we access through a debit card. But what do we need the most? What we need the most is a savings strategy, right? Everybody has a savings account. But what most people don't have is a savings strategy, and that's what we need most. What if I can show you a savings strategy that not only saves you money, but provides you renewable money over and over again throughout your lifetime and creates a lot of money when you need it the most? Now, is that something that you might be interested in? Okay, let's dive right into it. Now, there are two sides to this strategy. The first side, as I mentioned earlier, is life insurance, right? Why life insurance? Life insurance is one of the foundational pieces in your solid financial foundation if you plan to have a strong financial future. Life insurance is like the first layer that you need. You need to protect your greatest asset, which is you and your family. See, if life is tragically short, you need money for your survivors, right? You need money for your children, for your spouse, so that they can go on, so that their life doesn't have to be changed dramatically when you're not there anymore. And life insurance can do that. If life is unexpectedly interrupted, either through an accident or a disease or getting sick, you need money to pay for your daily expenses while you're recovering, right? What's going to happen with that? Especially if it's going to take you 6 months or longer for recovery. Now, if life is beautifully long, then you need money for your retirement, because there's nothing more tragic than living a long life but not having any means to be able to maintain your lifestyle. See, life insurance is the easiest way to create money when you need it the most. When life is short, if life is short, if life is interrupted, and if life is long. Now, that's one side of the strategy. The other side of this strategy is called, what we call at Archeo, unlimited cash flow system. Okay, the unlimited cash flow system. What is that? The unlimited cash flow system is a safe financial strategy that gives you back control of the banking function in your life. It's safe because, unlike an investment where by nature, an investment is risky. You're taking on the risk, you're investing your capital in that risk, hoping that it will be successful. And instead of losing money, you're going to make money. But there's no such thing as a no-risk investment. The unlimited cash flow system isn't an investment. It is a savings strategy. It's a system that helps you save money. So we don't want to lose money ever, right? We don't ever want to lose money. So it's a way that you never lose money, right? But you're always gaining it every year. And it's a strategy. It's comprised of several steps to reach your financial goal, right? And I'll explain what those steps are in a moment. But it also gives you back control of the banking function in your life. Quite often what we do to manage our money is we hand over the control of our money to the professionals, to the banking system, to the financial system. And what we want to do is to empower you to be able to take control of your own banking system, right? So that's what the unlimited cash flow system is. That's one of the things. Another thing about the unlimited cash flow systems is that it puts your savings or surplus revenue into a specially designed life insurance policy. Remember, it was two sides, right? Two sides to this system, the life insurance side and the unlimited cash flow system side. And you need one, you can't do one without the other, right? So you need a specially designed life insurance policy. Now, we call it specially designed because this is not traditional insurance. This is not the kind of insurance that you'll get from, your friend who became a financial advisor and is doing it part-time and that kind of thing. That's not, or your uncle or your brother who got his insurance license and now he's trying to sell you some term insurance or, final expense insurance. This is not that. This is a specially designed life insurance policy so that it can grow your money and protect your money at the same time. And this allows you to leverage uninterrupted compounding growth so that you can deploy your capital for your specified purpose, whether it's buying a house, financing your retirement, paying for university, whatever it is, right? Whatever you want to do with it. You're taking advantage of uninterrupted compounding growth within that policy to be able to grow your money. That's what we want to do with that, right? That's what we're trying to do. And that's how that works. Now, the advantages of having the unlimited cash flow system is that this strategy offers a number of benefits, actually. One is it optimizes your savings. And what I mean by that is that normally, for example, when you put money in a savings account, you're going to, like I mentioned earlier, it's going to be taxed. Whatever you make on it will be taxed. And we say, well, let me put it in a TFSA. Well, in a TFSA, yes, there's an investment component to it, but the investment, again, any investment is always risky, so it can go down. But generally, TFSAs are safe. But that's not the only benefit of the unlimited cash flow system. It optimizes it because what you can do is you not only use your money once, but you can actually use it several times, as I said before, because it renews. And I'll explain in detail how that works. Second, your money works efficiently. And when we mean efficiency when it comes to money, it means your money works more than once. When your money works more than once, which is what everybody does, everybody experiences this, where let's say you go to the grocery store, when you pay for your groceries at the cashier, your money has worked for you once. It has bought you groceries, but that's all it's going to do, right? You're not going to see that money ever again. With the unlimited cash flow system, you renew that money so that not only is your money growing in an account, you're also using it at the same time without interrupting that growth. You get whatever it is, the car that you want to buy, the house that you want to buy, the vacation you want to go on to, but your money continues to grow. That's not only optimized, that's efficient. Okay. Third benefit is that your finances are under your control. You control it. Banking system doesn't control your money. You control that, right? You have access to it. You can do whatever you want. No one asks you, what do you need this loan for? What do you need this money for? No one is going to ask you to do that. And when you access this through what we call policy loans, which I'll explain in a moment, they're unstructured. Unlike a typical loan that you would get at a bank or a lender, where they say, here's how much, well, this is how much we're going to charge you, and you got to pay the principal and the interest over a certain period of time, maybe 10 years for a car loan, 5 years for a car loan, maybe 30 years for a mortgage, and it's got to be, you got to pay it every month. This is what it is. It's structured. It's called a structured loan. And if you miss a payment, someone's going to call you up. You're going to get an email that said, hey, you missed a payment. If you want to avoid the penalty, you better pay this up. Well, with a policy loan, when you work with insurance company, there is no structured loan. It is not that at all. I'll explain why does that work. Another great benefit is that because there is that life insurance side to it, your loved ones and your business interests are protected, right? You've got that too. You know, you're not going to get this kind of protection from a TFSA. You're not going to get this kind of protection from an investment, right? Where you grow your money on one side, but how are you protecting? How are you protecting your money, right? So your loved ones and your business interests are also protected. Now, question: how would you use renewable money? I mean, what would you use it for, right? If you had if you had this kind of strategy in place in your life, you know, you could use it for reversing negative cash flow. If you find that you're losing more money than you'd like, and you notice that your cash flow is negative and your reserves are getting lower and lower and lower, you can actually use this system to reverse your negative cash flow. And you can talk to the person who invited you to watch this presentation to explain that, because we have several strategies on how to do things like that. You can eliminate bad debt using this, right? You can establish an emergency fund if you don't have one, because everybody should have 3 to 6 months worth of expenses saved up just in case. You can create a growing capital source for investing or for large purchases, right? And you can also develop a retirement strategy using renewable money. What would you use renewable money for? So now we get to the part where, how does this work? It's a strategy. So there's several steps to the strategy to reach our goal. The first step is to decide, right? To decide to systematically set aside a proportionate amount of your income as savings. Now, what do I mean by that? Why are we calling it proportionate amount of your income? Let me put all the cards on the table and be very honest with you. This strategy is not for everyone. I hope you consider it. I hope you discuss it with the person who invited you to find out if this is for you. But when I say it's not for everyone, what I mean by that is if someone has not developed the habits of being able to set aside a small portion of their income for savings, if they can't even do that, then this is not for that person, right? Because the first step is, it's a saving strategy for one thing. So you need to be able to have the discipline to set aside some money and not be tempted and not give into the temptation of spending that money for something else. So the first step is that you decide to systematically set aside a proportionate amount of your income as savings. The second step is to deposit that savings in a specially designed participating whole life policy where your money will grow using compounding interest and dividends, right? That's where you put your money. So it's like a vault that is growing every year. It's growing. You're paid both interest and dividends. And we work with insurance companies that have a track record of paying those dividends year after year after year. In fact, some of the companies we work with have been around for over 100 years, and they have never missed a payout. In 100 years, they've not missed a payout for a dividend. Now, those dividends have changed in terms of the rate that you get and the amount that you get. But one thing is for sure, you never get negative. Unlike an investment, you never lose money here. The worst case scenario, which has never even happened, is that no dividend gets paid out at all, right? Now, one of the reasons why this is such a safe kind of strategy is because when you contract with a life insurance company, they are legally obligated to make sure that they pay out the money that they promised in the beginning. Maybe it's $500,000 or $1 million, $1.5 million. And they say, by this time, when you reach this age, or if you die before that, we're going to pay that out. So they are forced really to make money. They're locked in to being efficient and effective with the managing of the money of the insurance company, because they know they have an obligation to you, right? So that's why you can put it safely in that. And so they pay that interest and that dividend, which grows your money within the policy. A third step is to, while you're doing this, you create compounding capital inside your policy, right? So it takes time to build that up. You're not going to have it overnight, right? Unless you put a huge amount, like a big amount of capital into the policy to begin with. You're gonna need time You need to be patient. It's like starting a business. It takes time for your business to break even, and then it takes time for your business to actually make a profit, right? Nobody makes a profit overnight. Regardless of the stories you hear, it always takes some time and investment, right? For a while. Now, in this case, you let time do its thing as you leverage, compounding growth inside your policy, and it grows your capital. Now, we want to use this, right? So it's not like you're going to wait forever and you're never going to touch it. Now, some people have policies that they never touch. They use it for later on, and maybe that's what they use for their retirement, right? But most people who have the unlimited cash flow system, they need it for a business, or they need it for expenses, right? To pay for large purchases. So you want to access your money. You can access your money to eliminate debts, to finance purchases, investments, and we do that using policy loans, which I explained just a moment ago. Then finally, just like a good businessman is, you want to repay your policy loans with the payments that you would have made to someone else's bank. See, here's the beauty of it. Rather than paying someone else's bank for the money that you borrowed, you're actually putting it back into your own bank, right? Because the insurance company lends you the money, your money's still growing and compounding, but you've got this amount that you paid because you've used your policy as collateral, and then you pay that back. When you pay it back, right? When you pay it back, you're actually paying it back to the insurance company, which you're a part of as a policyholder, that pays out dividends back to you. So in essence, you're paying it back to yourself, right? Now, if you say, well, that sounds good, but what does it really look like? Let me give you a visual about this. So if this is what's going on. On the bottom part of the screen, you'll see monthly or annual deposits, right? That's the hyphenated line, right? The hash marks. Now, what that represents are monthly payments. So monthly, you put money into, you set aside a proportionate amount of your income to put into your policy. That's what that represents. It could be annual, it could be monthly if you want, and as you put that, you put it regularly, right? Over time, over the lifetime of the policy, or you can do for 20 years, 10 years, 20 years, right? Or you can just keep doing it as long as you're working. What happens inside the policy is what's happening with the curve. This is the compounding growth curve. The money that you're putting in there, it gets paid every year. A dividend, interest and dividend gets paid by the insurance company, and it grows. Now, in the beginning, it seems slow, but then eventually there's a turning point, right? Where it grows exponentially like crazy. It's like the difference between what would you choose? Would you choose $1 million right now, or would you rather have a penny compounded every day for 30 days? Now, most people say, well, $1 million cash. Cash is king. We'll do $1 million right now. I'll take that right now. But if you did the calculations yourself, you could find out that if you did a penny compounding every day for 30 days, and what I mean by that is, on day 1, you have 1 penny. On day 2, you have 2 pennies. On day 3, you have 4 pennies. On day 4, you have 8 pennies. On day 5, you have 16 pennies. On day 6 is 32, and so on and so on. Just keeps doubling as you go every day. By the time you hit your 4th week, you're in the millions of dollars, more than $1 million. You're multiple millions of dollars by the end of the 30 days. That's the power of compounding growth. And I say, Mark, that's great and well that it's doing that, but how do I access it? Here's how you access. What you do with that, as you have enough money in your policy, you're going to use that as collateral and get a policy loan from the insurance company to put the down payment on the house, to pay for the car cash, right? With that policy, you pay for the whole thing. Don't finance it. Here's why you do this. Because look what happens. If you take a policy loan out, let's say you're going to buy a car. Let's say the car is $50,000, and you decide you're going to pay cash. So you take $50,000, take a policy loan against your collateral, and you pay cash, right? So you go to the dealership and you say, if I were to finance this, what would the payments look like? What would the interest rate be, and what would the payments look like? And they give you the numbers. Let them do the number crunching. And then if they say, oh, I want to get this car, and they offer to drop the paperwork for you, you say, oh, no, 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 I'm going to pay cash. So you pay cash. You pay the flat $50,000 plus sales tax and everything and whatever other fees that are there. You pay that flat. You're done with it. You never make another payment again to the dealership or to their lender. Instead, you're going to pay back that $50,000 to your insurance company rather than the bank that the dealership wants you to deal with, or the bank that will allow you to have an auto loan from them. Instead, you pay cash for that. You didn't pay any extra interest on it, right? No interest fees. And you're putting the money, when you make those payments, you can make the same payments that you would have made every month into your insurance company, paying back the loan. And then here's the great thing. When people pay off their debts, when people pay off their, let's say, their mortgage or their car loan, right? They're so happy. It's like, yeah, finally I'm debt free. They're debt free, but their assets or their money is at zero. Why? Because when you borrow money, you're in the hole for that amount. Let's say 50,000, and when you pay it back, you've just paid back that 50,000 plus the interest. You didn't actually make any money during that time, right? But with the unlimited cash flow system, once you pay back that policy loan, which takes some time to do that, of course, look what happens. Because your money did not stop working, you actually end up with more money in your policy than when you first got the loan. You made money while you borrowed that money, right? That is not only optimized, but that's efficient, right? This is a very powerful, powerful way to be your own bank and develop a renewable source of income, of money for you. Now, how would you feel if you had a renewable source of money available to you? Wouldn't that empower you? You'd be able to, you'd be able to fulfill some dreams that you've been meaning to do, because you have now a strategy to actually renew your money, right? Now, if you want to see how this could work in your specific situation, I want to encourage you to speak with the person who invited you to watch this presentation. This is most likely someone from Archaeo Financial Services, and talk to them about that. They'll do something called a financial needs analysis with you to find out what your specific situation is, because this is a customized plan. It's a strategy. It's not a one size fits all. It's suited to your budget, to your affordability, and to your goals that you want to achieve by having this kind of money renewed in your life. So stop losing money and start creating renewable capital with the unlimited cash flow system. Thank you so much for your time and consideration. I've been Mark Juane. Take care.